it's somewhere between 2026 and 2030 is where we think that $1 million from $40,000. I don't think people believed me when I said it on stage last week at Bitcoin 2022, but I meant it. And many people think, okay, so you're assuming that institutional investors become huge holders of Bitcoin. No, we're not. We're assuming, though, that they will move in gradually, and by the time we hit $1 million plus, they will have a 2.5% exposure to Bitcoin. Now, this is such a big idea, and that is such a small allocation. I think they will regret not having more because, as I mentioned, this is the first, each word I'm about to say is really important. The first global, big idea, private, meaning not overseen by any government, digital, rules-based monetary system. It is a big idea. And my mentor, Art Laffer, when he was collaborating with us on our first white paper in 2015 on Bitcoin, he said, this is what I've been looking for, a rules-based monetary policy. It might not be the right rule, but it's a step in the right direction. And of course, he means by that, it's a great store of value because it's mathematically metered to stop at 21 million units. So that's a quantity rule. So great store of value, scarcity meaning, but not a great means of exchange. That would mean a flat price. But we think over time, even that will, thanks to the Lightning Network, become more of a means of exchange and a unit of account, playing all three roles of money. And just to top this off, when I and Chris Berniski at the time, our analyst, were collaborating, I remember saying, Art, how big could this be? This is amazing. And he said, well, how big is the U.S. monetary base? And back then it was $4.5 trillion, and Bitcoin was $6 billion in market cap. Today it's $800 billion. He said, well, $4.5 trillion. Today, that number is $9 trillion. So, it's a very big idea. Bitcoin mining as part of utility ecosystems is going to accelerate the shift towards renewables. And the genomic revolution is going to help us grow food in areas maybe away from Ukraine, as it's in quite a bit of turmoil, in other areas that are not as friendly environmentally to food production. So innovation solves problems. That's all we do. We've got a lot of problems, and inflation is another problem. We don't think it's going to be long lasting, but if it is, and if one of the reasons is a labor shortage, automation, artificial intelligence, robotics solves problems. I think you'd be shocked to see how calm and focused everyone is. We're focused on our research. Are we getting this right? We have a 5-year investment time horizon. So if you look at the last 5 years, including the first quarter waterfall performance, the last 5 years we have handily outperformed the NASDAQ, the S&P. So 5-year time horizon is not just looking back, but looking forward as well. And putting this recent performance into perspective, you'll note that during COVID, so from April, whenever the market bottomed, through February of 21, our flagship strategy was up almost 360%. No, I'm sorry. Yeah, 360%. Down 60% from that at our worst. Very tough. And, I'm thinking about our clients, and I've been extremely gratified, we all have, that for the most part, they've stuck with us. Last year, our net inflows were $17 billion. Most of that weighted at the beginning of the year. And so they have felt the full force of this decline. And yet we inflowed last year, and we're inflowing this year. I think that has been shocking to a lot of our counterparts out there who have gone through periods like we've just experienced and have had massive outflows. We don't own any Twitter. And we've started moving out of most of the social platforms because there's a lot of competition out there, number one. I think Meta platform, so Facebook, the sharp deceleration in its revenue growth to somewhere we think or their guidance was 3 to 11% for the first quarter. That was shocking and really brought to light TikTok is taking a lot of oxygen out of the room. And Twitter also, I would say the management change was another reason for us. Whenever we see big management changes, typically we're going to expect, this new executive, even though he was the CTO, kind of putting his own mark on the platform. And so that causes some uncertainty. And I feel like Jack's leadership was very important to evolving Twitter to where it was. And his idea of even crowdsource the oversight, of the behavior on the platform, we thought that was moving in the right direction. And Parag's first few things we saw after his arrival was more censorship. So, one thing after another. Well, I think the market is going to train them over time now. So over the last 20 years, as you say, the market has outperformed the majority of active investors, the vast majority. And so that is career risk for a lot of, so we've had now a lot of benchmark hugging because it's been the right place to be, the markets, right? The broad-based indices. If we're right on the amount of disruptive innovation that is going to disturb the traditional world order, the broad-based benchmarks are not going to be the place to be. Now, they'll always be tried and true. There are some stocks that are going to be able to weather all of the disruptive innovation that we see because they have great management teams. But so many companies in the broad-based benchmarks have gotten used to giving investors a little adrenaline with manufactured earnings, share buybacks, or increasing dividends. And they've leveraged up to do that, and they have not invested enough in innovation. For the kind of innovation to participate in the innovation we see ahead, companies have to sacrifice short-term profitability and invest aggressively because we are in a lot of winner-take-most opportunities because of artificial intelligence.